Your salary has increased a lot, but you still feel poor. Not because you are wasting money and not because you are bad at managing it. It's simply that every time your salary rises a little, your lifestyle also begins to demand a little more. A nicer house, a better car, designer clothes, more comfortable dining, and before you even realize that you're earning more money, your money has already gotten used to leaving you faster. This video is not about living miserably or tightening your belt. It's just a calm conversation about why your salary increases, but you still feel poor, and how the next time your salary increases, your money can actually stay with you. My name is Sophia. With many years of experience working in banking, studying, and reading about personal finance, today I want to share with you how the endless loop of rising income and rising expenses can quietly keep you poor. You may actually be shocked when you hear about the average savings of Americans. According to statistics from the U.S. government, the average savings balance of Americans is only about $8,000. Broken down by age group, under 35 years old, $5,400, age 35 to 44, approximately $7,500, age 45 to 54, approximately $8,700, age 55 to 64, approximately $8,000, age 65 to 74, approximately $13,400. Why is it that with an average American income of around $60,000 per year, people are still unable to save even 10% of their income each year? There is nothing too mysterious about it. The simple truth is that most Americans are living at the edge of their limits, constantly falling into financial traps that almost anyone with money in their hands can easily fall into. Below are 11 temptations that feel as natural as breathing, which cause spending to expand. Almost everyone falls into at least 3 to 5 of them. Trap 1, the I deserve better mentality. Salary increases leads to reward yourself. When James gets a raise, the first thing he thinks about is buying a new car, upgrading to a new iPhone, or throwing a party with friends. These decisions raise James's financial commitments to a new level. Reward yourself once. It becomes your new lifestyle standard. After buying a new car and phone, James begins upgrading other things. New suits, new shoes, more expensive restaurants. Spending keeps increasing. His credit card limit increases, and the card is maxed out every month. The bank is very happy about this because they collect more interest from James every day. Rewarding yourself is not wrong. Turning it into a habit is the problem. Trap 2. Social comparison. A coworker buys a Mercedes. James sees his coworker's new Mercedes and thinks that once his salary increases, he should own one too. Friends checking in while traveling. Lisa, John, David, and Thomas are a group of friends who constantly travel and check in from Europe, the Middle East, and luxury shopping destinations. James cannot stay home forever either. When his salary increases, he now has the money to immerse himself in these enjoyable experiences. Social media showing success. When you post about your salary increase on social media, many friends will congratulate you, and many celebration parties will soon follow. Credit cards get swiped, and your savings may disappear during those late-night celebrations. Comparison burns money faster than inflation. Trap 3. Subscription, the silent money killer. There is a modern financial trap that many people do not realize until they check their bank accounts at the end of the month. That trap is subscriptions, monthly recurring payments. When your income is low, you tend to be very careful with every expense. You think carefully before buying something and before subscribing to a service. But when your income increases, something very common happens. Your spending also increases, especially with small monthly subscriptions. At first, they seem harmless. A streaming service, $10 per month. A music app, $12 per month. A work software subscription, $15 per month. Cloud storage, $8 per month. Gym membership, $40 per month. Each one seems small. You think, it's just a few dollars per month, but subscriptions accumulate over time. As your income increases, you subscribe to more services, more streaming platforms, work apps, food delivery services, AI tools, online learning platforms. After a few years, you might be paying $150 to $300 per month for subscriptions you don't even use regularly anymore. Let's do a simple calculation. If you pay $200 per month in subscriptions, that's $2,400 per year. If that money were invested at 8% per year for 20 years, it could grow into over $100,000. The dangerous part is that subscriptions don't feel painful immediately because they are automatically deducted. You don't take money out of your wallet. You don't press buy. The money simply quietly disappears from your account. That's why many people call subscriptions financial leaks. Each one is small, but together they can slow down your wealth building process for many years. Trap 4. Eating out and convenience. I work hard, I deserve good food. Food delivery and coffee every day. When your salary increases, you suddenly have more ways to satisfy your hungry stomach. And you tell yourself it's worth it because you just got a raise. Not expensive per meal, expensive per month. Trap 5. Housing upgrades. Renting a nicer apartment. Moving to a better neighborhood. When James receives a salary increase and now has more money in his pocket, he naturally starts thinking he deserves to live in a better apartment closer to the city center to save commuting time. The thought is natural, and the money in your pocket quietly disappears as a result. Housing becomes the most dangerous expense when income rises. Trap 6. Upgrading your car. Low monthly payments make it seem affordable. But in reality, it locks your money for 5 to 7 years. Car dealers never say the car costs $50,000 up front. They say, you only need to pay $800 to $900 per month. You just got a raise, and you think you can afford it, and that you deserve the newest model. Trap 7. Buy now, pay later. James wants to buy new phones, laptops, and technology. Lisa wants new dresses, cosmetics, handbags, and shoes. The brain says it's only a small payment each month. In reality, you are spending your future money today. Trap 8. Image pressure. Dressing well, throwing parties, maintaining the image of a successful person. When you start earning more money, not only does your life change, society's expectations around you also begin to change. When you were a student or just starting your career, wearing simple clothes, using an older phone, or driving a normal car was not a big deal. But when your income increases and your job title improves, an invisible pressure appears. You must look more successful. Newer phone, better clothes, more luxurious watch, better car. Restaurants and entertainment that match your status. No one forces you, but signals from friends, coworkers, and social media make you feel that your image must upgrade with your salary. Financial experts call this lifestyle inflation. For example, if your salary increases from $3,000 to $5,000 per month, theoretically, you have $2,000 extra to save and invest. But what usually happens is phone upgrade plus $40 per month, better car plus $250 per month, clothing and shopping plus $150 per month, dining and coffee plus $200 per month, travel and entertainment plus $200 per month. Very quickly, most of your raise disappears. On the outside, your life looks better. But financially, nothing really changes. This is why many people earning $8,000 to $10,000 per month still feel like they are not building much wealth. It becomes a consumption loop based on image, where every upgrade leads to another upgrade. Trap 9. Taking on more financial responsibility. Sending money to family. Gifts, weddings, celebrations. Another financial trap that appears when income increases is that your financial responsibility toward others also increases. When you earn less, people expect less from you. You split restaurant bills with friends. When visiting family, a small gift is enough. But when people know that you are earning more, something changes. You gradually become the one who pays the bill. Dinner with friends. Don't worry, I'll pay. Coffee with coworkers, you cover it. Family gatherings, you spend more. No one forces you, but you feel like you should because you are earning more. Over time, these expenses accumulate. A dinner, $60 to $100. A gathering, $150 to $200. Helping relatives, a few $100s. Each expense seems reasonable, but at the end of the month, you may realize that a large portion of your income has gone towards supporting others. The dangerous part is that this trap is hard to notice because it is connected to generosity, relationships, and family responsibility. Helping others is good, but without clear boundaries, your income can increase while your savings remain the same. Some people even become the financial supporter of their entire family. No one forces you, but it's very hard to say no. Trap 10. Increasing credit card limits. Banks invite you to increase your limit. Spending becomes easier. It's not your money. It's just money you are allowed to borrow. Trap 11. Investments that are actually spending. Buying expensive items to save time. Buying courses you never complete. Buying equipment you never use. You convince yourself that buying a $2,000 coffee machine will stop you from buying coffee outside, or that a high-tech dishwasher will save 30 minutes per day. Many purchases feel like investments, but after you buy them, they become unnecessary expenses. The common loop: salary increases leads to spending, increases leads to nothing left, leads to hoping for another raise. This is the trap that keeps many middle-income earners poor for life. Simple solutions. To escape these traps, you don't need to starve yourself or live miserably. You can take these simple steps. Solution 1. Automatically save and invest. Automatically allocate 10 to 20% of your income the moment your salary arrives. For example, James earns $6,000 per month. He automatically transfers $1,000, $700 to investment fund, $300 to emergency fund. When his salary increases to $7,000, he increases his allocation to $1,400, $1,000 to investment fund, $400 to emergency fund. With this system, James stays financially calm in every situation. Solution 2. Create a spending plan. Make a monthly spending plan. Plan groceries. Plan dining out. Plan loan payments. Plan travel. If every expense is planned weekly, monthly, and yearly, your spending becomes controlled. Saving money then becomes only a matter of time. Solution 3. Delay lifestyle upgrades. When your salary increases, try to keep your old lifestyle for at least 6 to 12 months. Don't rush to buy a new car, house, or expensive items. Before making a purchase, ask yourself, will this make me richer or just make me look richer? I'm Sophia. These are lessons I've learned from my own journey. I hope they help guide you towards success. If I missed something, I would love to hear your comments and suggestions so we can all improve together. If you found this video helpful, please like and subscribe to motivate me to create more content.